Very good. Very good. All right, folks, this is Prashant Kumar. Some of you know me already. That's why you are here. But those who don't know me, I'm just going to introduce myself a little bit. Uh, I'm the owner of my company. My name of my company is My Realty Gains Management. I kind of like that Realty Gains. That's my caption. I mean, all of my companies, they have that name, Realty Gains, Steeplechase Realty Gains, My Realty Gains, whatever. So uh, just a little bit about myself. Those who don't know me, I come from a very strong technology background. I have worked in corporate America for last 25 years in all capacities, manager, senior manager, director, and but over a period of time, I have realized that I have always traded my time for the money. When I did not work, I did not get paid, or I got paid only what the limited amount, based on the corporate policies. So that has led me to the realization that I have to bring something in my life through which I'm kind of creating time for myself and creating some passive incomes. And that started my real estate journey. A lot of you are in the similar boat. I own about one or two apartment complexes, 100 units for myself. I've done about 1,200 units under management up to 2019. This year, we haven't done much. We have done about 300 units this year so far, but 2020, we did not do much. My primary expertise is to remove the redundancies from the processes, because of my experiences in the corporate world. I use some of that skill in the real estate also and try to streamline the processes and try to remove the redundancies and create some value for ourselves, for our investors. I come from a very humble attitude, humble background. I am into assisted living space as well. We are in some LOIs right now in assisted living space. I own assisted living facilities. I've been involved in that for last 2-3 years now. We do a lot of webinars. We do a lot of Facebook lives, LinkedIn postings. We run a meetup here in New York, and try to connect with like-minded people. That's the goal. That's the goal of this webinar. There's nothing else. We have never sold anything on any webinar. And those who are interested, stay put till end. I have some freebies which I'm going to share with you, and in the end, maybe we'll share something which you may or may not like, which you may be interested in after hearing our great presenter. So that's what I had about me. Having said that about me, I'm going to not bore you anymore. I'm going to stop this presentation, and I'm going to introduce the presenter that whom we had today. Okay, it is my pleasure and honor to present David Monroe, to invite him to talk today about current multifamily demand. Right, David is a multifamily investor, broker, consultant, and he's a strategic partner, and he specializes in market analysis. Guys, those who are not, can I put you on mute? Somebody started talking. Sorry. I just, give me 1 second. Let me put everybody on mute. Yeah. So I was saying that David is a strategic partner, and he specializes in market analysis, demand and supply analysis, market cycles, feasibility analysis, and teaches that specialty as a CCIM instructor. He's a CCIM instructor. He's not just a CCIM designee. He's a CCIM instructor. He teaches all this in CCIM Institute. He has always advises on lending options, acquisitions, dispositions, after tax strategies, and has unique ability to connect to syndicators, sponsors, key principals, and investors. His primary skill set is to get the deal closed. So he kind of works with all the parties on a project, and he gets the deal closed. David, thank you so much for your service. David was a U.S. State United States Marine for 11 years, 4 months, and 22 days. Thank you so much for your service, David. And, as usual, just a little bit more, your passion and focus are to build strategic partnerships with syndicators, sponsors, and key principals. And he invests passively and he builds wealth, for family legacy. So David, thank you so much for joining today. I would let you, share all the knowledge that you can to this group.
I appreciate it, Prashant. Thanks for that long, warm introduction. I do have an introduction slide through the presentation here, just a few slides, but I'm going to be very brief about it. Let's see, I can't. There he goes. He muted. All right. So market analysis, demand, supply, multifamily demand can be very boring, very dry, and a bit of a snoozer. So we're going to actually try to have a little bit of fun with it today and see if I can't make it a little bit exciting. I do want to preface, though, that you guys will see a lot of those expert gurus out there that will try to get you to believe that you're in some kind of an emerging market when all they'll do is show you past performance. They'll take and look over the last 20 years. Oh, okay, well, if this market's grown from here to here in the last 20 years and 7%, 10%, 15%, then it's going to continue to do that. And I'm going to tell you that past performance in no way, shape, or form ever predicts future results. We're going to predict future results with math. Now, we're not going to do it in this class because we don't have time for that. You can ask Prashant. He just completed CI 102 with CCIM. And it took about 20 to 30 hours to discuss how to predict the future. So we're going to talk about how to calculate current demand for any multifamily market anywhere in the country. This works anywhere in the United States. Sorry, Gotti, I don't believe this will work in Israel, but if you're investing in the US, this will work in the US. So how to calculate multifamily demand in your market. Today's objectives: understand the current multifamily market cycle. Where do we find the data? It's great if we say, hey, the market's doing great, we got these jobs coming, but how are we actually going to determine whether it's a strong market, a stagnant market, or a declining market? So we're going to look to see where we find data in order to determine those things. Then we'll get into a little bit of math, how to calculate current multifamily demand. And then I'm going to take a high level approach. And again, very high level, keep it very brief, and kind of give you a sneak peek on what it takes in order to calculate future multifamily demand. And yes, there actually is a mathematical equation that allows you to get there. It isn't a bunch of guessing from what happened in the last 20 years. All right. So just a little bit about me. Prashant told you most of everything that really needed to be said. I'm just going to add a couple of details here. My email address, and that is my cell phone number. Texting is the best way to get me in the middle of the day because, like Prashant, I am constantly on Zoom all day long in meetings, so I don't answer the phone very much, but I do respond to texts when I can. I'm a multifamily investor and strategic partner. We have the LP, the GP, and the KP. I am creating a new position within the syndication space called the SP, as if we didn't have enough Ps already. And if you guys ever want to know about what a strategic partner is, reach out to me. I'll be glad to talk to you about it. I'm a certified CCIM market analysis instructor, as Prashant had mentioned a few minutes ago. That means I teach CI 102 for the CCIM Institute. You can see my my faculty badge kind of down here in the bottom corner. And if you kind of look on my shirt, you see I'm wearing a CCIM faculty shirt just by chance today. It just happened to have been the next shirt in line to wear. I'm the Florida CCIM VP of Education for this year and next year. I'm on the CCIM Tech Board from this year for the next 2 years. That is a board inside the CCIM Institute that you have to be voted by the board of directors of the Institute in order to be on. So I'm very proud to be on the tech board. I'm also on the foundations board for the next 3 years. I'm a former syndicator, now strategic partner, as I've mentioned, and I've owned a property management company in the past. We got up to about 330 units when I decided to shut the doors and sold off all the property contracts, including the ones that we owned. We gave them to a third party so I could focus on doing other things. Okay, enough about me. Real quick caveat, you see a lot of stuff here about CCIM. This is not a course that was written by CCIM. It was 100% written by me, taken from some of the fundamentals that I teach for CI 102. CCIM does not endorse this course. I don't even think they know about it. There's plenty of CCIMs that have seen the course and love it and think it's a great segue from the massive 20 to 32 hour, depending on how you take the course, CI 102, but this is not a CCIM endorsed class. So please don't think that. All right. Understanding the current multifamily market cycle. Most of you guys have probably seen in the past some form of a market cycle chart. Most people are familiar with Dr. Muller's cycle chart. We will be going over that in just a minute. And I want to, let me grab my little handy dandy tool here for a second so you can kind of see what I'm doing. Let me get my spotlight tool. So we start over here in phase 1, okay? In phase 1, we're kind of starting to come out of a recession and into recovery. So if we look over here where recession is, we're coming down. That's this little line right here. Now we're starting on the way back up. So around between 09 and 10, we're sitting down here, okay? And now we're starting to work our way up. So down in this section here, you're below the long-term vacancy average or long-term occupancy average, depends on whether your glass is half empty or half full. And in this section, you probably still have some negative rent growth. Your vacancy might be starting to stabilize, or you might still have a little bit of vacancy occurring, but typically as you start, especially when you come from point 1 to point 2, you will see that vacancy start to slow down. Okay. As you continue up and you get towards that long-term average, now rents are equalizing and even starting to increase a little bit. Vacancy is decreasing until you get to that long-term average. Once we cross that long-term average, we then get into expansion. So right about here was about 2012, in between 2012, 2013, most markets crossed this line. And if we look here, we can see that we kind of have, I call this the NOI line. It's never really been identified, but if you think about, if my vacancy is decreasing, and sorry about the dogs in the background, I can't control that. If vacancy is decreasing, concessions are decreasing, so our occupancy is increasing, our rents are climbing, our NOI is increasing. So NOI is correlated with you going up the market cycle chart. Once you get into expansion, things start to accelerate pretty quickly. And then we have this little green circle right here that says new development. What this means is that rents have now gotten to a point where the market can afford new development. All right. Once we get to this point, now you're going to start to see permits being pulled. You'll start to see ground being moved. Things will go under construction. And as we get up here, that we start to have some deliveries. And now we start to work towards equilibrium. Equilibrium is that point when demand and supply is equal. So rents aren't going up, they aren't going down, vacancy is stabilized. Everything is just kind of hunky-dory and everybody's marching along, but they're not really paying attention because permits are still being pulled. Groups are still going under construction. Units are still being delivered as we get into hypersupply. Permits are still being pulled. Products still going under construction. Units are still being delivered. And that's why when you look at a normal market cycle chart, it kind of really goes gradual, nice and smooth up to this point. and then it drops off really fast. And the reason is as absorption cannot keep up with the deliveries, as things are being delivered on the market, that's when things really start to go downhill. Vacancy starts to tick up, rents start to decline, even though right here we may still have some rent growth, but vacancy is picking up because we have all these deliveries. We're still getting deliveries here. Rents are really starting to decline now. And as we drop and vacancy goes back below that long-term average, puts us into a recession. And then really quickly we hit towards the bottom. So it can happen from about 0.1 to up to equilibrium. You know, we've seen it last 12, 13, 14 years. We've seen it go anywhere from 8 to 15 years in a recovery market. But when we get into oversupply or hypersupply and into recessionary cycles, it can happen really fast, especially once you get around this point, things start to really pick up. And so this could typically be anywhere from 18 months to 36 months. And then you start back up this cycle again. So luckily, we spend much more time coming up than we do going down. All right. So that's and as we cross this, obviously our vacancy is continuing to increase. The rents are continuing to decrease. And as long as you bought your property correctly, then you'll be okay. This is where a lot of your foreclosures starting to happen.
So what is the current state, David, in your opinion? Where are we right now in the market
So
cycle?
market to market, it's going to be different. If you want to think about nationally, which I try not to think nationally, we're probably somewhere between these 2 points in oversupply nationally. Okay. But there probably aren't any markets that are over in expansion. Almost all will be either here at equilibrium. Some will try to say, you know, Dallas and Orlando and some of the markets, Austin, where people are just continuing to move, Huntsville. You could probably have an argument that they could be on this side right now. You'll see when we get to Dr. Muller's chart, it's third quarter 2020. It's lagging big time. Another reason why these aren't really good indicators to try to determine what your market's going to do in the future. But for the most part, most of your markets are here, with a few of your markets here, maybe even here, like New York City, San Jose, San Francisco, places like that.
Is there a place where folks can get the Dr. Muller charts, just like on the web or someplace?
Yeah, Dr. Muller, you'll see here in a second, like real quick. It's Mueller, Glenn, Glenn Muller. He is the creator of these charts. He's at the University of Denver in Colorado. If you look him up, I can't remember the name of the company that he's with, but you can subscribe. I think there is a fee to get it. Okay. So if you look at third quarter 2020 at the apartment market cycle analysis, he's got about 1/3 of the markets at equilibrium. He doesn't have anything in expansion. And then 2/3 of the markets are in oversupply or hypersupply, with San Jose crossing that long-term average, right? Where you see +1 means last quarter, in second quarter 2020, San Jose was here. When you see a -1, like here's Denver -1, that means in second quarter, Denver was here and it went back 1. Okay. Jacksonville was 13, came back 2. So that's how you kind of read this chart. So these are the top 50, maybe even 55. It's somewhere between 50 and 55 MSAs in the country. That's really all he tracks. So here's a little fun play on this, and I'll try to be brief, but I like to have a little fun with this. So this is kind of how the stock market reacts, and you'll see that there's some correlations here. So as we come down out of recession and into recovery, we start to get some of these dips, and you get this disbelief as things start to go up, and then it starts to come down a little bit, and then you're like, yeah, you know what? There may be a little bit of hope here, and then things continue to climb, and then some optimism kicks in. Now, keep in mind, nobody's putting their money in the market yet. Okay, this is stock market. So optimism, now it really starts to go up, and then they get into belief and say, okay, now way up here, let's go ahead and start getting invested. And they start throwing all their money into the market, right? Way up here. And then they ride that thrill ride all the way to the top into euphoria, and wham, we go into, excuse me, we go into this massive amount of volatility where we're up and down and up and down and up and down and up and down, but it keeps going. Every time it goes down, it comes back up. So we get complacent. All right. We're enjoying this euphoria. We've made the most money we've ever made in our life. And now we're starting to get complacent because we dropped all the way down here, had this correction, and it's come back up here. And then boom, we start to go down big time. And then anxiety kicks in, says, oh my goodness, now I'm going to have to get into these margin calls. You know, the dip's taking longer than expected, and it just really keeps to go down. Remember, we bought up here. Now it's in denial. My investments are with great companies. They'll come back. They're all blue chip stocks. And then down here in panic, there's, oh crap, everyone's selling. I need to sell. Get out, get out. So we bought up here. We're selling down here. And then capitulation sets in. It's like, did it again. Another market cycle, screwed up again. I've lost all my money. Then you get mad at the world. It's the president's fault. It's the governor's fault. It's my wife's fault. It's not my own. And you ride the wave of depression. And then as it starts to go back up again, you're right back in disbelief. So there's a little correlation here right now. If you look at the way the market is, if you think about multifamily right now, we're kind of in two little pieces of position. Everybody's riding high in euphoria. Prices are higher than they've ever been. And most would say way above what they should be. Because of that, we're also sitting at complacency because they're really not paying attention to what's going on. There's still construction happening. Even though everything's in oversupply, there's a lot of complacency happening. So multifamily is kind of sitting about right here, right now. So just pay attention to what's happening in your market and be ready to ride that wave down when it comes. I don't know when it's going to come, but it's coming. We haven't seen it yet. Those that are saying that we're already riding the wave back up from the recession of COVID. No, sir. No, ma'am. We have not hit our recession yet. It's a coming, and it's going to come big. All right. So you guys ready to do a little math? Oh, not yet. We're not going to do math yet. I'm going to delay you just a little bit. Okay. So first thing we need to do is we need to determine where do we get our data from. So I want you guys to take this link. Let me see if I can copy this.
I don't think you can copy it here.
Yeah, it doesn't matter. I got it right here.
Yeah. Oh, here. Yeah, you can copy it here and paste.
So somebody in the chat box or say it over the
just paste it in the chat box.
Yeah, somebody give me a county.
Anybody wants to give a county?
Bergen County, New Jersey.
Yes.
Bergen County, New Jersey. Okay. BERGIN.
BERGEN.
Bergen County, New Jersey. All right. So you can see here at Census Quick Facts. Now I know there are these gurus that like to tell you about city data and all these other places. Well, why go to these aggregate websites that are going to pull older data from Census? Just go direct to Census. Go to the horse's mouth. The really great thing about Census Quick Facts is you can benchmark up to 4 areas at one time. You can't do that on any of those other aggregate websites. So if we look at Bergen County, New Jersey, we can see how it benchmarks against the United States. What's a city inside Bergen County, New Jersey?
So Matt, what is the city you want?
Westwood.
Westwood.
Westwood. Westwood Borough.
Yep.
Okay. So now we can benchmark the city against the county against the US. You could even get rid of the US and you can put in an MSA in here. So if this was part of the Trenton MSA, and I have no idea, I don't know much about New Jersey. You could benchmark, you can even add the MSA to this and benchmark one more thing. So you can't do that on any of those other sites, but there's some pieces of information we need here. We need total population. So if we look at population July 1st, 2019, we should be seeing, well, there's April 1st, 2020 right there. They're not quite giving it yet. They've given it for the US. They're not giving it for the markets yet. We probably won't see those until either fourth quarter 2020 or first quarter 2021. Now, if you have a CCIM membership, CCIM has ESRI. We get free access to that. ESRI does their updates every July. So next month, ESRI will be updating. They've been told by the US government that they are going to get the new census data in that update. I'm really looking forward to that. That is going to tell a big tale as far as what's happened in the last 10 years in this country. And CCIMs are going to be the first to be able to see that. Okay, so we can also come down here. We're going to need some other pieces of information like owner-occupied housing. We need to know how many renters we have in the market. Okay, we also need to know how many people we need per household. Okay, so we can see that we got 2.52 in Westwood Borough. We got 2.71 in Bergen County. Up here, we got owner-occupied housing is 64.8. If I want the inverse of this, which I do, which is called tenure, that's our owner-renter ratio. We want the number of renters. So we just take the inverse of this. So it would be 35.2% would be the renters inside Bergen County, New Jersey. All right. So just some pieces of information that we can get from Census Quick Facts. There is one piece of information we can't get from there, and I'll let you know what that is when we get there. Okay. You're also going to need some, so that's our demand data. One thing I want you guys to understand, people are demand. People need a place to live. People need a space in order to run a business. People need a manufacturing facility in order to produce goods. People need an industrial warehouse in order to store goods. All right. People own land. So people is your demand. In the retail sector, and Prashant just learned this, in the retail sector, money is your demand, but people spend money. So it's still correlated to people. Everything else is a space, including a unit or a household. And we look at our supply side data, our spaces, from paid sources. There really aren't any free sources that we could go to find good supply side data. So we go to CoStar, we go to Reese, Yardi, Axiometrics, Real Capital Analytics, or we walk the market. And walking the market is probably the most accurate. This is where you actually call the HR departments of the companies and say, how many people you have employed? It's a little onerous, but it is a way to do it. Okay. So those are the two places we get our data. We get our demand data from Census. We get our supply side data from CoStar, Reese, Yardi, Axiometrics, any one of those aggregates that will provide that supply side data. We're also going to get our demand data when we start getting into employment from Bureau of Labor Statistics, but we're not going to look at employment until we start looking at future. So I'm going to get into detail on employment. So first thing we need is total population. And we saw where we can get that on Census Quick Facts. We want the owner versus renter ratio. We want the average person per household. And you guys saw all three of those. But then you did not see non-household population or group quarters. For whatever reason, Census does not publicly publish this. And I don't know why. I can't get anybody to answer the question why. But ESRI, through Site to Do Business and CCIM, through our reports, does publish group quarters. So if you ever need to know what group quarters are, you can just reach out to Prashant or me, and we'll provide that information for you. But in most markets, it's not going to be that much. So a group quarter would be like a prison. So it's non-household population, prisons, assisted living facilities, halfway houses, student housing on campus, not off campus, but on campus, military base housing on base. These would all be forms of group quarters, and they are considered non-household population. And then we need to get our vacancy allowance. And that's why we've got our supply side data up here, is because we're going to need to add vacancy back in, because when we do our demand analysis, we're going to get to 100% occupancy, but we don't ever want to be at 100% occupancy, or nobody could ever move to the market. So we want to put vacancy into the market, usually utilizing that long-term occupancy average. All right, so let's do a little bit of math. We're going to pretend, yes.
Sorry, just before you go into the math, I noticed that some of the data was dated like 2015, 2018. The fact that we just had the COVID thing go through, and the fact that, you know, the data is a bit dated, does that really make an impact, or do you adjust to that?
It is going to make an impact, but here's the good news. Nobody has any more updated data than that. That is the most updated data. So you're not going to be losing anything by not having access to it yet until ESRI gets their update, and then you will be behind, because then we'll have the current data. But you've got to think about how the census does their surveys. So they survey every 10 years. And then every 2 and 7 years, they will do estimated updates. And then the AHS does it, or it's AHS does it every 2 and 7 years. And then census does it every 5 years, or something similar to that. So about every 2 years, you're getting some sort of update, but it's a mathematical update. It's not a survey. So it's really just a guesstimate anyway from census. What matters are jobs, and you guys will understand that in a minute. That's really what drives everything, are jobs, but not just any job, specific jobs. And I'm going to cover that in detail. Answer your question, Matt?
So just one more thing, just to emphasize what we are talking about today is the current market demand, how to calculate that, right? It's just not, I know it may be a little bit not so much interesting webinar for some of the folks who want to hear, you know, all the buzzwords, city data and all that, you know, like all the tip of the finger kind of calculations. It's not so sexy, but it is really the meat. You know, everything else is all just the coverings around this. So it's very important, if you have an opportunity to learn this, learn it.
Thank you, Prashant. Exactly.
Mm-hmm.
All right, so we're going to pretend we're in Monroeville.
Yep.
Well, it just so happens that about 50 miles north of Mobile, Alabama, is a little town called Monroeville, which happens to be the capital of Monroe County, Alabama. I'm not referring to that Monroeville. I'm David Monroe. It is my Monroeville. So this is fictitious. So these are just fictitious.
And there is a town called Monroe in New Jersey, not too far from
there's
Bergen
Monroes
County.
all over the place. But I just have to preface, this is not Monroeville, Alabama. This is my Monroeville in, you know, in passive wealth US. Let's just say that.
Mm-hmm.
All right, so we have a total population of 100,000. We go to census. Census tells us we have 100,000 total population. We then have to subtract out those group quarters. So I go to ESRI. ESRI tells me we have 1,000 group quarters. And when I look up in Google and try to figure out non-household population for Monroeville, I realize that we have a small university that's got some housing on campus, and that's why we have a group quarters of 1,000. Okay, that's going to get us to our household population for Monroeville. So far we have a demand of 99,000 units. We already know that's not the case. So we have to divide out the number of people per households. Well, in Monroeville, it's 2.5. If you remember, in Bergen County, it was, I think, 2.7 when we looked at it.
2.6,
So
2.7 in that
something
range.
like that.
Yeah.
So we're going to divide that 99,000 by 2.5. And this is going to tell us how many rooftops are needed to occupy 100,000 people in Monroeville, United States. So 39,600. Now, this is all housing units, owner, renter, everything. So now we need to take our tenure or our owner versus renter ratio. In this case, we're going to use 32%. I think we found in Bergen, it was like 37.2 or something like that.
35.2.
Yeah. When we multiply the 39,600 by the 32%, that gets us to, now this says multifamily units, but that's really not true. This gets us to our our rental units of 12,672. As we know, especially right now, single family rentals are a real big demand. So it's not just apartment units, it's also single family rental units, condo rental units, any kind of rental unit is included in this calculation. Now, where you've got a little caveat here and where you have to be careful is if you go to CoStar, you go to Reese, you go to Axiometrics, they're only going to give you the multifamily data. But I heard a story, and somebody that's really close to CoStar has told me that CoStar is in the process of purchasing an API that is going to give us single family rental housing data. And if you cannot tell the smile on my face right now, you have no idea how important that is. So for those that feel like ponying up $1,500 a month for CoStar isn't worth it, I promise you, it is way more than worth it. So now that takes us to 100% occupied. So if we've got a population of 100,000, that means we need 12,672 rental units to satisfy this demand. Here's our demand. Here's our supply. So we need 12,672 units, but that's at 100% occupancy. So we don't want to be at 100% occupancy. So if we look at Monroeville's long-term average, it tells us that it's 7%. So if we take 1 minus 0.07, that tells us it's 0.93. So if we divide 12,672 by 0.93, that tells us that we have a total rental demand. Again, shouldn't say multifamily, should say rental demand of 13,626. Okay. How simple was that? I now know what my demand is in the market. So now if we go figure out what our supply is, so are we in oversupply or is there a gap? So in Monroeville, we already know, because we just calculated it, we need 13,626 units to satisfy our demand. Now, if we take the total units in the market of 14,200, that tells us that we have an oversupply of 574 units. So if we look at, remember, we added our vacancy in here for this. So when we subtract this out, if we're at 7% here, then we're probably around 8.5%, 9% here. Still not a bad situation. You're probably a little bit in phase 1 or maybe a little bit in phase 4 in this situation, but you're right on the cusp of being right in 2 or 3. So it's that simple of determining whether you are in, whether there's a demand or whether there's an oversupply. That's it.
So David, just by going to the Census website and number one, going to the Census website, picking up the data, and number 2, getting the information on the group quarters, we were able to determine the demand. It was less than 5-minute exercise, right? I mean, it did not really take any more than 5 minutes for anybody to understand the demand in the market. And supply you get from other sources like CoStar, Axiometrics, or someplace, how many rental units are available.
Build great relationships with brokers that have access to that data and just ask them for it. They'll give it to you.
Yeah. Awesome.
Yeah, that's it. So now comes the hard part. That was the easy stuff.
Yeah.
Here comes the hard part. Okay. I'm going to go real high level here. Please try to stay with me because this can, I can get into the weeds, but I promise I'm not going to. So now we're going to talk about calculating future multifamily demand. Yes, we can have a crystal ball and estimate what our future demand can be 12 to 24 months from now. Okay. So we have to do what's considered an economic base analysis. Move something out of the way here. All right. The economic base analysis is a two-part process. Part 1 has 4 pieces to it. Part 2 has 3 pieces to it. Part 1 is our current economic base. Part 2 is our future economic base. We're looking for 2 pieces of information in part 1 so that we can calculate part 2. That's kind of how it flows, and we're going to go into that here in a minute. We also need to look at the correlation between jobs and population, and I'm going to give you the probably deepest explanation you've ever heard about employment in the United States. I guarantee you've never heard this explanation unless you've heard it from me or taken CI 102. Okay, so part 1, current economic base. That is a 4-step process to determine those 2 multipliers that we're going to need. And then part 2, future economic base, we take those 2 multipliers and we add them to the jobs that are coming to the market, and it will calculate our future population. Right? So current economic base. First thing we have to do is identify industry sectors with basic jobs. This is a 4-step process. Step 1, identify industry sectors with basic jobs. What the heck am I talking about? Well, let me just jump out real quick. I'm going to come up here and we're going to go into QCEW, and I'm just going to pick the United States. We've got 4th quarter data now. That's pretty new. Jump in here and you're going to see these NAICS codes, 11, 21, 22, 23, 31 through 33, 42. These are NAICS sectors. All right. These are your industry sectors. This is the 2-digit sector. You can go up to 6 digits. NAICS was created during NAFTA, the North American Free Trade Agreement, back when Clinton was the president of the country, which created free trade between Canada, the United States, and Mexico. And they all utilize these NAICS. The NAICS from 2 through 5 digits are identical in all 3 countries. The 6-digit NAICS is specific to the individual 3 countries. All right. So we're going to pull this data in order to determine our industry sectors with basic jobs. All right. So what the heck is a basic job? This, if you miss anything else in this presentation, pay attention to what I'm about to tell you. This is the most important part. You will always hear that a market is determined by its employment. That is true, but it isn't just any employment. If I go back to the Bureau of Labor Statistics, notice we have this 1.0 right here. Okay, this is called our location quotient. The United States is our baseline. If I come over here and I grab Baldwin County, Alabama, and we look at Baldwin County, Alabama, now notice they're not 1.0 anymore. There's ones that are greater than 1.0, and there are ones that are less than 1.0. Anything greater than 1.0 is considered to be a basic employment sector. That means that it is a export sector job. And I'm going to explain that here in just a second. If it is equal to or less than 1.0, it is considered to be support sector or non-basic. When we're working in economics and determining the future growth of a market, we only look at export sector. So it's got to be greater than 1.0. All right. You guys already know 90% than every other syndicator that are doing deals right now. And we haven't even got into the basics yet. All right, so export sector, what does that mean? So I'm going to take Huntsville, Alabama as an example. Huntsville, Alabama, about 3 years ago, announced that Mazda Toyota was going to build a manufacturing plant to build cars in that state, in that city. And they promised 4,000 jobs. Okay, so we can go into our Bureau of Labor Statistics, look at the manufacturing sector for Huntsville, Alabama, go into the Huntsville MSA, or that would be Madison County, and determine whether manufacturing is greater than 1.0. If it is, that means those jobs are export sector. Now, you can really determine whether it is or not just by following the money. So if we look at who is paying the salaries for Mazda Toyota, well, it's Mazda Toyota in Japan, right? So they're building the cars. The employees live in Madison County, probably Limestone County, maybe some other counties around the area, commuting to the market, but they are being paid from Japan to for their salaries. The cars that they're building aren't being sold locally. Maybe a few will be sold locally, but the majority of them are going to be put on trains, shipped to an internodal facility in Greenville, South Carolina, where they'll then they'll be trained to the internodal. The containers will come off, they'll get on, put on a truck and truck to Savannah, where they'll go on to a ship and then ship globally for sale. That money will then go to Japan, where they'll then do payroll and then pay those employees. Those employees will then go into the market and they will pay their mortgage, pay their utility bills, buy their food, buy their clothing, buy their entertainment. Okay. But they're not just going to spend the money in their market. Maybe they want to go to the beach. Maybe it's 4th of July weekend coming up. So they take their salary and they drive south 5.5 hours and they go to Baldwin County and they go to Gulf Shores and spend a week at the beach. Now they're spending their salary in Baldwin County, not just in Madison County or Limestone County, which is in the Huntsville MSA. So there's leakage coming out of the market. All right. The key is that you have more export money coming into the top of the market or coming into the top of the bucket than what's leaking out the bottom of it from those employees spending money outside that market. That's why having export sector employment is so critical to any market area. So here is Mazda Toyota. They are pouring money into the bucket is Huntsville's MSA. And then the leakage are the employees in the market that are going to the beach, or they're going to Dollywood, which is just up the mountains, or they're going to Pigeon Forge or Nashville, Myrtle Beach, wherever they're vacationing, they're spending money outside that market. The key to any market is that you have more export sector jobs flowing in the market than what's leaking out of the market. If you don't have any export sector jobs and you just have a stagnant market, then that leakage will drive that market down, and that's how you get a declining market. It takes new jobs coming into the market in order to fill that bucket back up again. Do you guys understand that? That is the biggest takeaway of this entire class. All other jobs are considered support sector jobs. So let's say Prashant opens a bakery in Huntsville. And let's say Bob decides that he stops at that bakery for bagels every day on his way to Mazda Toyota. Prashant makes the bagels in his shop and he sells them to the local people that are in the market. He then takes that local money, pays his local employees, who then go into the market and spend that money locally. That's local money circulating inside the market. Okay. That's just inside here. It's not outside here. So if we didn't have this outside money coming in, then as people leave the market to spend money, the market will then start to really decline. The other thing is when a job, an employment sector leaves, so let's say Mazda Toyota shut the plant down, churned the spigot off, there are other basic employment sectors or other non-basic employment that will be affected by that. More than likely, Prashant's bakery will close because he was used to everybody on the way to Mazda Toyota stopping at the bakery and getting their bagels, and then stopping on the way home and getting fresh pastries for the wife as they're heading back to the house. Well, if that plant's not open anymore, then Prashant's bakery is probably closing. So that's how it all affects each other. All right, so once we know how many basic jobs are coming to the market, either coming or leaving, it works in reverse the same way it does, as I just explained, in positive order. So now we need to calculate current total basic employment. Now, that's a fancy way of saying, if we go back to, and I'm not going to get into the math in this at all, if we take this location quotient and we factor it in by the sector for the local area, we can determine how many basic employees are in this sector. When we add up all the basic employees That will give us the total basic employment for the entire market. We then take the total employment for the market, divide it by the basic employment for the market, and that will give us what's called our economic base multiplier. So that's where our next step is. So once we calculate all the total basic employment, we divide total jobs by the basic jobs. That gets us our first metric, economic base multiplier. We must know what that is. What that says is for those 4,000 jobs that are coming to the Huntsville market, let's say that it's 4.0. So that means that for every 4,000 jobs, multiply that times 4, then we've got 16,000 total jobs coming to the market. 4,000 of them are basic, 12,000 of them are non-basic, okay? Then we calculate our population employment ratio. Now we go back to Census Quick Facts and we get the total population for the market, divide it by the total jobs for the market, gets us our population employment ratio. If we say the population employment ratio is 2.5, then that now gives us our second metric for determining future populations. So now we got our EBM, we got our PER. We can now go to step 2, which is future economic base. Close that door, Dylan. All right, so estimating future basic employment is step 1. This is a 3-step process. Step 1 is we got to determine the future basic employment coming. In this case, it's the 4,000 jobs from Mazda Toyota. Then we need to estimate future total employment. Remember, we had a 4.0 economic base multiplier. So we take the 4,000 jobs, multiply it times 4.0, tells us we have 16,000 total future employment coming to the market. The final thing we do is estimate future total population. We take that 16,000, we multiply it times 2.5 because we said that population employment ratio was 2.5. That tells us that we have 40,000 people coming to the market from those 4,000 jobs. Now, how powerful is that? You just got from identifying a company coming to the market, building a manufacturing facility, you were able to determine what the future population is going to be 2 years from now based on that employment, if that company is delivering those jobs at that time. So you have to take that into consideration, okay? Questions?
I know it is a lot of information, guys, and David kind of talked about it in like very fast, right? But this is the key. I mean, if you know this, it is beyond anything and everything that any of the gurus in multifamily world teaches us. I mean, I've been through that, and I'm sure a lot of you have been through that. But have you really found a real answer of what is my demand going to be? I don't think any of us have found it. We just were following the herd and running towards Atlanta or towards Dallas or towards Austin because everybody else was going without knowing shit about it, actually. Sorry for my words. But I mean, it's always good to know what is the fundamentals of why these things are happening. So, I mean, you have some time, ask questions, feel free to ask any questions,
I got a couple. I can kick this off.
Please.
So I'll ask both the questions and I'll let you answer them. One of the questions was that it sounds like there wasn't much judgment involved. This is all just a mathematical exercise, and apologize if I mischaracterized that. But if that's the case, then why isn't somebody just doing that? Like I think Glenn, you mentioned, might be doing that and just giving a report out, like rather than us sit over there and do this for every market. Let's just have somebody do it, and we can all share the wealth. The second question was that given the hot markets that we have right now, maybe Austin, Dallas, I think Atlanta, to name a few that you just did, Prashant. Are those really the markets where we expect to see the future growth? Like, is there any truth in following the herd?
There is no truth to following the herd. Don't follow the herd. Do the calculations, understand how to do it, and do it for yourself. Those that follow the herd will follow the herd right off the cliff. Is there current demand in those markets? I think it's proven there is, but how long will that sustain? That's what nobody knows. And that's what nobody teaches except CCIM with 102 and what I teach with this. You've got to know what's it going to do in the future. You can't just say, okay, it's been great up to this point. We see there's people moving to the market. And again, identifying what are those sectors that's actually moving there or not. And you've also got other people move into these markets, not even job related, which is throwing the numbers all off for everybody because of COVID. And so when this all settles, when all the dust settles and everything calms down, anytime you want to enter a market, you should do a full economic base analysis so that you understand that market to its fullest. Until you do an economic base analysis, you're not going to know that.
Let me take a stab on that again, David, a little bit more. Past performance is not indicative of future performance, right? You have heard it many, many times everywhere. And that's what we all look at the past performance of Atlanta, Austin, Dallas, and we think that it's going to go up. Yes, it has been going up for some time, but for how long? And that's what David also said, that for how long is going to go up, right? So that is something that we have to determine, right? I mean, if you are a syndicator, you have ethical responsibility or fiduciary responsibility to invest in the markets which you know that is going to go up. Yes, we have been following the herd and we were making the money for some time, but I think it is prudent to say that we are at a juncture. You saw Glenn Mueller's graphs, which come every quarter, I would think, who's from Colorado, right? And if you subscribe to that data, that actually gives you the information where those markets are. Are they in recession or in hyper supply, or are they starting to come down? So if your market is starting to come down, is it wise for you to go in those markets and invest when you have 3 to 5 year horizon for your investors, where you are promising your investors at least 15 to 20% return on their money? I mean, if the market is going down in 5 years, you probably wouldn't be able to return their money, as it is. I mean, maybe your whole period would be longer, So, equations will change, at that time. So, I mean, this is to make you feel more comfortable. I know it is being taught in CCIM, and I am also taking CCIM, by the way. I got influenced by David, and I know him very well. And he said, no, don't take it. I still took it. He advised me not to take it, but I'm kind of a stubborn guy. I said, okay, I'm going to go for CCIM. I'm working on my CCIM, and I know a little bit about this. That's why I was nodding my head all along. But it is amazing information to me. This information goes a long way. I mean, if we know it, and just knowing it a little bit now you open the world for you. I mean, right? So far, you did not know what you did not know, right? Now you know it. I'm going to send this recording back to you guys. Feel free to watch it again and again, and you will know, ask questions. I'm here to answer any questions in future also. And of course, David is there too. Does it make sense?
Here, I'll even do one better for you, Prashant.
Mm-hmm.
If it'll let me. So nope, it's not going to let me. Well, maybe it will. Let me see.
I must say it's amazing information. And I think 90% of the groups that doing multifamily and raising money and syndicators doesn't acting by this information. They're going like massive herd for, it's amazing, really.
All of us. I'm even saying about myself, right? I mean, all of us are like following the herd. I mean, following everybody, and that's what we have been doing. So it is great information. I mean, if you know it, you practice it in your day-to-day life, soon you will know you have become the master of this.
I just posted my slides to the chat.
Yeah, so you have the slides for this presentation. Feel free to download it and copy any of the stuff, do a control A, you will select all the chat. Guys, feel free to share your contact information. There was one thing which I promised that I was gonna give it out as a freebie. I mean, because I'm a syndicator also. I do a lot of webinars and stuff. So I have a 7-day email course, and which is about passive investing, benefits of passive investing. So I'm going to leave the link of that here in the chat for everybody. Feel free to copy it, subscribe it. It is again free course, 7 emails, 7 of my videos. I mean, I love to talk on video, even though I'm not that smart, but whatever, it doesn't matter, at least as long as I can deliver the content.
You're a heck of a lot smarter than you put on to be, that's for sure.
Thank you, Steve. Thank you, David. So yeah, I mean, I have a 7-day email course, and I have a passionate passive investors club. It's just a little bit deeper information, not asking you to, there's nothing to be sold. Everything is all free. Just, check it out. If you like it, subscribe to it. If you don't, it doesn't matter. We'll cross our path someday, somewhere else also. But I mean, whatever, I just want to emphasize this again. In last 5 slides, whatever David told, that is the key information. We all should learn that. That's all I can say. Okay. And although in this webinar, we have never sold anything, and that's not the purpose of this webinar at all, and David did not want to do it, but David has a class, a smaller class, which he teaches, and it just, I don't know what he charges, maybe $90 or something, $99 or something.
It's 97.
97, yeah. Feel free if you want to take that class to learn it. David did not want me to say it, but as a respect of his time, I just said, listen, I'm going to mention it in the class. Anybody who wants to take it, feel free to register for that. I mean, David, feel free to drop the link in the chat box if anybody wants to register, up to them to learn it.
Thank you, Prashant. Appreciate that.
No worries. I mean, I know this is great content, and I mean, it's a lot of effort also for you to kind of explain everything. So I just wanted to mention it to the group. But again, that's never the purpose of this webinar. This is over the last 2-3 years, this webinar has always been free. There's nothing we make, and that's not the intention. And as much as I know David, that's not the intention of him talking today. We just came to talk about the information, freely, basically. Any other questions, guys? All right. So, I mean, if there are no more questions, it is about 9:07 Eastern. We are just 7 minutes past the hour.
That wasn't my fault. I finished right on time.
Yeah, you finished right on time. I thought it was going to go for at least 30 minutes beyond the hour, but you kind of stopped it right on time. Thank you.
Can I jump with one more question?
Please.
I'm wondering, David. Sorry, I didn't get a chance to the first question I asked, which was the one on the whether, if this is all mathematical, then why don't we just why don't we just sort of do the math and just give everybody the data? And secondly, that which markets are you investing in?
So pretty much anywhere in the Southeast that makes sense. If I'm not familiar with the market, obviously I'm doing a full EBA, economic based analysis. The reason that it's not done all the time or not taught, one, it's misunderstood. People don't know it. The other is it's hard. It's not easy. I gave you guys the high level version of the future estimate, but we teach that literally it's 20 to 30 hours of education to teach you how to do that calculation. I get it down to 8 hours in my other course that Prashant just told you guys about. And I teach how to do that calculation, but I just, instead of showing you how to do the math. I just give you the spreadsheet so you can copy and paste it into the spreadsheet and it calculates it for you. But you still have to go into the marketplace and you still have to survey the market to determine the total net jobs coming to the market for basic employment sectors. So, you know, how many are coming, how many are leaving, what's that net? And then you have to interpret that data through doing the rest of the economic base analysis. People don't want to do all that work. And so that's why I can charge anywhere from $10,000 to $20,000 to do a market analysis for somebody. Even the CCIMs that go through 102, 90% of them will never go back and look at that class ever again. It's just way over their head. It's too much for them. They're numbers people. They like financial analysis. They don't like market analysis because market analysis can be very subjective. Yeah, we have a lot of objective numbers in calculating, but it's still subjective data because it is still a guess. It's an educated guess. It gets us a heck of a lot closer than where we were before we did it. And it's the industry standard to be done. But when it's all said and done, it's still an estimate. It's still subjective. That answer your question, Peter?
Yeah,
We lost Peter.
Yeah, I think we lost him, but at least it is being recorded, so it will be going out to him. Yeah, I mean, to your point, it is, I mean, it's not a blind guess anymore, right? I mean,
Correct.
You know, me going to Memphis and start investing in Memphis. Yes, I know about Memphis, you know, Amazon is opening their thing, Nike City is coming, blah, blah, blah. But if I did not know that those things were coming, how would I do it? You know, what makes me feel better about Memphis today than 3 years ago? So, I mean, to me, it is something that I should do every time I go to any market and start investing there. All right, guys, sounds good. Thank you so much, all those who joined and those who did not. You will get the recording if you had registered for this webinar. Again, this is always a free webinar that we do for listeners and try to create some value. At any time you have any information, you need any information about the webinar, please contact me, Prashant at MyRealtyGains.com. MyRealtyGains.com. That is my email address, Prashant at MyRealtyGains.com. Those who want to share your contact information, please feel free to share it in the chat. And in the end, do a Control-A and Control-C. That will copy everything to the clipboard, and then you can paste it in a document somewhere. But once again, thank you so much all, and good night. David, once again, thank you so much, sir.
Thank you, Prashant. It was fun. I enjoyed it.
Yeah.
Bye, everybody.
Yeah. Bye now. I'm going to be there for a few more minutes just to make sure that everybody is able to copy all that information from the chat window. And Gaddy, I'm going to contact you, sir. Let's talk sometime soon. When can we?
Yeah. We can talk tomorrow.
Okay. I got I'm
24/7 almost. Also Saturday and Sunday.
Okay.
Full power.
4 to
so you can text.
Okay, 424-330-8157, right?
Yeah. And you have my email also, and
yeah,
I will text you the link of the group and also my personal link of Facebook also, or LinkedIn.
Okay, I'm going to text you right now. You know what? Before I forget.
Okay, amazing.
Yeah, I'm going to just text you right now. But nice to meet you, Gaddy.
Me too. And really, I personally want to say thank you for this webinar. It's amazing information. Good to see you first time, live and connect with you. And I think basically we're going to have a wonderful period of time and we should get ready. As I see the market going to do a U-turn,
Yeah,
And if we'll be, right on time with cash and with investors, we can do amazing stuff and get really good properties
that's
because
what.
the prices are insane.
Yep.
It's
That's what we are waiting for. Also, I mean, we have been sitting on cash for some time, and we are waiting for that discount to happen sometime. We are
I
buying,
think
but
it.
yeah,
I think it will be, even though we see prices rising all over the world, also in Israel and in Europe.
yeah,
But basically, the money is printing, and when money is printing, someone needs to pay in the end for this printing,
yeah,
insane printing of money.
yeah. No, I mean, we know that now. We know how that now. So, but I would let you go back to bed. It's
Thank you.
too late for you. And I
Thank
sent
you, my
you a
friend.
text. I hope you have received it.
Yeah, I receive it and we'll text you back in a minute.
All right, sir. Thank you so much, Gary.
Thank you. Thank
Yeah.
you very much.
Good
Bye-bye.
night, sir, to you. Good morning, actually.
Yeah.
Anybody else has any questions? Pat, Marcus?
Hey, Prashant, good to see you, buddy.
Hey,
I'll talk to
Jay.
you offline.
Hey, how are you, sir?
Doing good, sir. Thank you. I'll connect with you offline.
Yeah, I mean, we can talk right now if you have a few minutes.
Yeah, I mean, let me give you a call back.
Okay, all right. Thank you, guys. I'm going to hang up and we'll go from there. Thanks, guys.